Now, let's try to identify factors which determine exchange rates. So, uh, firstly, we start with balance of payments and trade flows. So, when we say BOP or balance of payments, it's a summation of three items. So, we have a current account, a capital account, and reserves. So, these are the three components which we consider as a part of BOP or balance of payments. Now, balance of payments is something which every company monitors. So, especially economists, they are going to keep a close watch on the BOP or balance of payments because these have an impact on the way in which exchange rates are going to move, and also at the same time, it will also have an impact on the way in which things happen in that respective currency, the respective currency area, or I would say that particular market or economy. Now, balance of payment is dependent on the level of imports and exports which are done by the country naturally, because every company which now every country they are going to require to import a few things and they may be exporting something else. So, for example, if we take an example of India, then India is a very large exporter of agri produce because India is primarily an agrarian economy. So that way, a lot of food grains and those agricultural commodities are exported by India. So India is an exporter for agri and agri related products, something maybe like cotton or wheat. Whereas India is a major importer for crude oil because India exports most of their crude oil from imports most of their crude oil from abroad uh, because that way we don't India doesn't have its own reserves. So depending on its requirement, it imports oil from abroad. Now, this has an impact on the overall balance of payment. So, depending on the level of imports and exports, that will have an impact on BOP. Now, to understand how exactly this will have an impact on FX rates, because that's what we are interested in, isn't it? Because since we are studying or reviewing FX rates, this is something which you should be able to understand. So let's take a simple example and try to understand how it works. Now imagine country X and country Y. They are engaged in trading of goods and commodities. Now let's say exports from country X to country Y increase. So let's say the people in country Y are consuming a lot of products which are produced by country X, and that's why the exports from country X are rising. Then in this scenario, what would happen is since the demand for country X products are higher, then that way the demand for the currency of country X is also going to be high because the products will be denominated in their currency. So naturally the demand for the currency of country X also rises. Now, as a result, the goods which are denominated in the country X currency will become more expensive naturally, isn't it? Because we have current country X and country Y with their respective currencies, let's say X and Y. Now, if the demand for X is going to rise, then naturally it is going to become more expensive related to Y because people in country Y, where the Y is their currency, they will have to procure X in order to purchase the products which are coming in from X. So that way, because of this, the country X's currency is going to appreciate as compared to country Y, and that way the goods which are made by country X are going to become very expensive. And in response to this, this will naturally push down the demand for goods from country X because people in country Y will say that the products which we used to consume from country X are simply too expensive now and we can't really afford them. The next scenario could be now we spoke of exports. Now let's look from an imports perspective as well. Now, if the imports by country X from country Y increase, uh, that is people in country X want more and more amount of products which are produced by country Y. So that way, in this scenario, the demand for country Y's currency is going to go up, isn't it? Because the demand for the products from country Y has risen. So as a result, the demand for currency of country Y is also going to rise. As the demand for the currency Y rises, then that is going to appreciate vis-a-vis currency X. And whenever this happens, then the people who are importing from country X, they are going to find it expensive to purchase product from country Y because country Y's currency has appreciated vis-a-vis country X. So it is becoming unaffordable for them to purchase more and more products from Y. And this is going to push down the demand for goods from country Y. So this is how imports and exports are going to have an impact on the FX rates. The next factor which impacts exchange rates is inflation. Now, inflation is always a major point of discussion for any country's monetary authority or for any finance ministry for any country, because inflation basically plays a very important role in determining how exactly a certain economy is going to behave, or maybe it's going to grow or not grow over a period of time. So, in very simple words, inflation implies how expensive has it become to purchase a certain asset, and that has an impact on every asset which you look at. So, be it financial or non-financial assets. So, a rising inflation scenario is always seen as detrimental from your assets perspective. So, inflation plays a very, very important role when we analyze or when we study of FX rates. Now, one important relationship which will help us relate inflation with the idea of FX rate movements is the PPP, or purchasing power parity. Now, let's take an example to understand this. Now, let's take a currency pair USD CAD and the spot rate is 125, 1.25. Now, to prevent the arbitrage opportunities, we expect that the price of a certain basket of goods uh, will be 25% higher in Canada as compared to the same basket of goods in the United States. So, when we talk of inflation, remember that we are talking from a basket of goods perspective. So, everyone is familiar with the terms of CPI and WPI. So, CPI stands for a consumer price inflation and WPI stands for a wholesale price inflation. So these inflation numbers are always calculated on a certain basket of commodities. So that's the same basket of goods which we are talking about. Now, to understand this argument better, now let's say a certain product costs $100 in USD, America, and it costs 130 in Canada. Now, a certain arbitrager could actually buy the product in from the United States, and he or she could simultaneously sell it in Canada in order to make an immediate profit of 0.05, because spot exchange rate of 1.25 versus this product difference. So 1.25 and 1.3. Now, when you say 100 and 130, that's basically 1.3, isn't it? So difference between 1.3 and 1.25, that's 0.05 benefit on the Canadian dollars. So that can be like an immediate profit which can be realized by that particular arbitrager owing to this price inefficiency. So although theoretically this appears to be a very lucrative opportunity, in practice it may not be possible always. So maybe yes, for a certain point, certain time, this could be a profitable opportunity, but not for very long, because there are a lot of other factors which play a role. So that way, capturing in this arbitrage opportunity may not be possible. After we take into consideration things like transportation cost, any kind of transaction charges which are being levied, tariffs, etc. Now, all of these things would render this opportunity to be not possible from a practical perspective. So, although theoretically it is there, but in practice, it may not be possible to capture. Now that we have discussed the arbitraging idea, let's try to also see one more example and see the impact on how exactly an exchange rate is going to move based on a certain price level. Now, now this will help us further understand how the purchasing power parity works. Now, assume that the inflation in the United States is 3% per year, and inflation rate in Switzerland, where Swiss francs is their currency, it's 1% per year. Assume that the current spot rate is 1.07. Now, if the purchasing power parity holds now, and the PPP holds in the medium to long term. Now, there may be certain imbalances which may exist in the very short term, but in the medium to long term, the purchasing power parity holds. Now, the cost of a basket of goods worth $100 in the United States will be worth 107 Swiss francs in Switzerland. Now, in 1 year's time, after factoring in these numbers for inflation, we know that the same basket of goods will cost 103 American dollars, because we know that the inflation rate in America is 3%. So $100, which was the initial worth, into 1.03 is 103 US dollars. And in Swiss francs, we use this rate of 1%. So 107 was the earlier cost in Swiss francs. So 107 CHF into the 1% growth in price through inflation. That is 108.07. Now, through the concept of PPP, this suggests that the exchange rate should become 1.0492. So we take the CHF rate 108.07 and the USD rate of 103. So this is the rate which we expect from the purchasing power parity perspective. So here, if you observe that the exchange rate has moved. Now the spot rate earlier was 1.07. Now it is worth just 1.04. This suggests that the CHF has strengthened, isn't it? Because initially 1 USD could purchase 1.07 Swiss francs. Now 1 USD can only purchase 1.0492 Swiss francs. So that way it suggests that the CHF has strengthened by close to 2% against the dollar. And it is this precise appreciation in CHF vis-a-vis the American dollar that would make or render the arbitrage opportunity impossible to capture. So this is further how exactly PPP can relate with the way in which FX rates move. And the third factor which has an impact on exchange rates is the actions of monetary policy or monetary authorities of countries. Now, monetary authorities also have a certain role to play whenever we talk from an exchange rates perspective. So every country has a certain monetary authority. So generally, it's the central bank of that respective country, which is the monetary authority. So in America, there is the Federal Reserve. In India, we have the Reserve Bank of India. Now, all of these are monetary authorities, and they create what we call as a periodic monetary policy for the country. Now, for example, if country X decides to increase the money supply by 30%, and let's say country-wise is going to keep the money supply constant, then we would roughly expect that the currency of country X should depreciate by 30% relative to Y. Now, the supply of money within a certain system will be again governed by the monetary policy. So that respective monetary authority can decide whether it wants to increase money supply or whether it wants to reduce the money supply. So a couple of important operations which it does for just for your information to adjust the money supply is either through changes in policy rates. So the CRR, repo rates, etc., which are studied under the policy framework. So policy rates, or next could be even open market operations, which are conducted by monetary authorities in order to control the amount of money. So open market operations. So a couple of popular techniques whenever it comes to management of money supply. Now, monetary authorities also keep a close tab on the way in which the currencies are moving vis-a-vis their currency. So, for example, if I take an example of India, then in India, the Reserve Bank of India keeps a very, very hawk eye, or it keeps a close eye on the way in which USD INR rates are panning out. Because USD INR is by far the most liquid currency pair which we observe when we talk from an Indian market's perspective. So they keep a close tab on the way in which USD INR rates are moving, and in case if required, they intervene into the FX market. And if you recollect, there is one item of the balance of payment which we call as the reserves. So it is these FX reserves which are used by the monetary authority of the country in order to intervene in the FX market. Now, generally, the monetary authorities will try not to intervene in the FX market and they'll allow the market to take its course. However, there could be certain times whereby there could be too much of volatility in the currency, or maybe they want to stabilize the currency up to a certain level. So at that time, the monetary authority might decide to intervene, and that way they may want to stabilize the country's currency vis-a-vis their main or vis-a-vis their major other currencies. So, for example, in India, we mainly look at the USD INR rate as a benchmark whenever it comes to stabilizing the rupee.